All right. Today is the 18th of July, and I was just doing some back testing, so I thought I'd make a quick video. And really, what I wanted to try to showcase, along with um, just getting the familiarity down for myself of looking at regular trading hours in relation to electronic trading hours. So, um, ICT talks about regular trading hours. One day picks up where regular trading hours left off the previous day. Obviously, there's a gap. And so I was going back through the continuous NASDAQ futures contract and just doing some back testing. So that's what I thought I would just go ahead and make a video, more so really for my repetition of being able to just quickly go through and see what I'm looking for, know what I'm looking for, and how to quickly ascertain it within a few minutes, and then jump back over to the 1 minute chart for to frame my New York Open trades. So, without further ado, let's get into it. Basically, what I've found in my back testing is this is basically what I normally do is I will go mark out the 9:30 open, and then I'll go below that price, and mark out the most recent 15-minute liquidity below price, as well as the 15-minute swing high above price. And again, I'm on regular trading hours, 15-minute chart, Eastern Standard Time, New York time. So then it will go in, and below price, I will mark out the most recent or relative inefficiencies. And here we have a regular trading hours buy side imbalance, sell side inefficiency. So we'll mark that as such. And then below the most recent swing low, that if we want to hit it could be a target, would be this small inefficiency right here. Now, there could be a volume imbalance in there where that inefficiency is a little bit larger, but I'm not going to worry about that at this moment. So we'll put that on there. And then above price, we have this small inefficiency here. And we'll mark it as a buy side imbalance, sell side inefficiency. And then we have one more here. And I'm hoping what you can see is you're going to be able to see the relationship between regular trading hours previous day or previous days, because we'll cut through candles, to the current New York Open, and how I think you'll be able to see how regular trading hours picks up right where it left off, not necessarily the previous day, but previous days. So those are our actual inefficiencies from a fair value gap perspective, or buy side imbalance, sell side inefficiencies, or sell side imbalance, buy side inefficiencies. But we can't forget the most important inefficiency, which is the previous day's close to the open in the form of our opening range gap. So we'll put those quadrants on there. So now let's go to the 1 minute chart. And you can see what we have here is this pre-market sell buy side and pre-market buy side. That's basically the pre-market starting at 7 o'clock, between 7 and 9:30. That is the buy side liquidity and the sell side liquidity. So keep in mind that everything that we have on this chart, aside from the pre-market buy side and the pre-market sell side, is it is all based off of the 15-minute bellwether chart, regular trading hours. So our 9:30 open is this price right here, and I'll just leave it the way it is. That's also the low of our opening range gap. So 9:30 opens right here at that price right there, the low of this candle where that candle opens. And we can see that the market trades down into the 15-minute inefficiency, which, if we go back, we can see is not even a reclaimed bullish fair value gap. It's actually the first use regular trading hours of that BC. So as the market opens and trades down into it, here's the consequent encroachment of that 15-minute buy side imbalance, sell side inefficiency. And then we can look at this and go at 9:45. So basically the first 15-minute candle closes right there. And the new candle opens right there. So we'll call that a 15-minute open. So when that candle opens, the new 15-minute candle opens, you can see that we're not able to get below the consequent encroachment of that 15-minute BC. So if we go back to the 15-minute chart, we can see, obviously, the bodies are telling you the story. The wicks are going to do the damage. So the bodies are telling you the story. Now, out of curiosity, let's look at something here based on where those bodies stopped. Let's just look and see. There does not appear to be there's no volume imbalance right there. So if we were to grade this with our quadrants, just out of curiosity, so obviously it makes it below the upper quadrant, but fails to get to the consequent encroachment of it. My guess is if we put our octants on there, it's going to be land on an octant, those bodies. So that's giving you the narrative, very plain and simple. And we're only 15 minutes into the New York opening range, 9:30 to 10 o'clock. So right there, we already have something that's based off of the bellwether chart, regular trading hours. So here's our first presented fair value gap right here. So during 9:30, obviously we have, if this is our 9:30 open right here, this right here is going to be our AM so far to current time. That's going to be our Where did I have it? AM, that's going to be our AM buy side liquidity currently. So if we, with the first 15-minute candle and the open of the second 15-minute candle, is not able to get below or even down into touch the consequent encroachment of that buy side imbalance, sell side efficiency, that's an extremely bullish signature. So I'll leave it for another time as far as actual entries go, but from a framing a trade perspective off of higher time frame New York Open, trade down into a regular trading hours, higher time frame, bullish inefficiency, fail to get to the consequent encroachment of it, and then we trade back up above first presented fair value gap. We close above a swing high there. We close above a swing high there. We have change in the state of delivery there. We also have a change in the state of delivery down here. But from an entry perspective, there, that hits right on the first octant of that 15-minute buy side imbalance, sell side inefficiency. And so from there, even if from a trade perspective, if all we were to target would be the AM buy side, you would be right there, and that would give you, if you targeted this inefficiency right here and got your fill there, there's 82 handles in 6 minutes with 0 drawdown if you had a limit order right there. I'm not going to try and get into too many entries at all. Sometimes I go off on the little bit of a tangent talking about different entries because of what I see, but nonetheless, let's just keep it at this. First 15 minutes, there would be a trade right there if you're inclined to trade the first presented fair value gap trade. Obviously, when we have a opening range gap in a premium, then our eye is going to be on 50% of that opening range gap right here, which is going to be the consequent encroachment of it. So when we are obviously not able to go lower here, we can frame our trade based on this is where our next draw would be. And then from there, our draw could be the pre-market buy side. So as the market trades up, we take out the AM buy side and then continue on. And our 10 o'clock is right here. There's our 10 o'clock. So what we've done is we've opened and traded down into a higher time frame inefficiency, failed to get to consequent encroachment of it, 1 minute change in the state of delivery. If we go back to the 15-minute, now that we're at 10 a.m., if we go back, we see that right here at 9:30, we have a change in the state of delivery. So right here, 9:30 is we have a 15-minute change in the state of delivery. Right there. So from two perspectives, one could use that as I took this trade to, if you took this trade here to the AM buy side at 10 o'clock, you can use this many different ways. You could use this as, are we going to be able to get above these highs here? You could use this as a confirmation on whether you want to hold your trade to try to get to the 25% or 50% of the opening range gap, or just enough to get to this this buy side right here. Again, that's electronic trading hours. Oops. Our regular trading hours is this pre-market, or electronic trading hours is this pre-market buy side, but the bigger draw is on the 15-minute bellwether chart is this inefficiency here. So that's one example of using the 15-minute regular trading hours chart. What we can see in reality is still, if we want to continue on with reading the market here, what we have is our opening range is from here to here. That's our 30-minute opening range. Here's our first presented fair value gap. And so the minute 9:59 closes and 10 o'clock opens, from a liquidity perspective, without worrying about trying to hit home runs and just looking for setups that pay the bills, your first liquidity after 10 o'clock is going to be session highs and lows. So you're going to be looking at this high or this low of this opening range. So at 10 o'clock, it opens up and takes out the high of this as well as grabs this sell side. So while 70% of the time consequent encroachment of the opening range gap is hit, it's not always hit, or it may get hit later in the day. We've done what we need to do so far in the opening range. At 10 o'clock, we have our range. Then the high of that is taken out. So then if you want to go move from a first presented fair value gap trade to now we're post 10 o'clock, now we're going to go off of a silver bullet trade. The high of this range is taken. So now from a narrative perspective and a bias perspective, if we're not sure and the market's not running and it's consolidating, our next draw until we find something different is going to be the low of this. It may not get to the low of this, but our draw is going to be bearish until we find something different. It may only need to go just low enough, since we failed to get below consequent encroachment of this 15-minute BC, then we may draw down into the upper quadrant of that BC on a higher time frame perspective, which we do right here to rally up towards the consequent encroachment of that. But you may not know that. So know that once this opening range closes, to not shoot for home runs and to just go off of how the market prints. In this scenario, we are showing that we're of high willingness to go higher, or a strong willingness to go higher, but we don't know, and our bias is higher or bullish, but we don't know the narrative. How is it actually going to deliver there? So here we have 10 o'clock opens right here. There is, let's make it black and a little bigger. So 10 o'clock opens, trades down, trades back up, takes out this high here, as well as this pre-market buy side. It's not the highest pre-market buy side, but it is buy side from pre-market and essentially relative equal lows or highs right there into this inefficiency, but fails to get to the consequent encroachment of this inefficiency. Let's go right there. And fails to even get to the lower quadrant of that inefficiency, and then begins to break down with some consolidation. Obviously, we have a small little gap right there, but that's not really my cup of tea for a silver bullet. I usually look for more displacement. So this is where the 10 o'clock candle opens. and takes out sell side or takes out buy side right there and there. So let's make this buy side a little bit bigger. Oops, that's not what I wanted. Sorry, this buy side right here. And I'll just make it yellow so you can see it. So that's the last buy side it takes out right there. One more push above it. Now, granted, I wouldn't necessarily use this as the silver bullet, but there is a volume imbalance right here. So this gap right here is going to be used as an inversion. This fair value gap that was created before this last buy side liquidity was taken out, again right there, we took out the one from pre-market, and then this one right here, and this little gap that was created right before that is going to be used as an inversion. So it's up to you, your risk, your confidence, what have you, on whether you are confident in taking a trade like this, selling short as it trades back up into this inversion, or whether you are more comfortable waiting for the more quintessential ICT trade of the silver bullet, and then a return to that would be right there. That would be your entry. And again, our draw, since we already took out the high of that range, again, our draw is going to be lower. So that doesn't necessarily mean it's going to take out that low, but at a minimum, we would look at the equilibrium of this 30-minute range. And then lower than that, we have our first presented fair value gap. But let's take off the octants of this here real quick. And so we would sell short there with a bearish draw, understanding that a little bit of our higher time frame draw would be the midpoint of our opening range gap. Again, your bias can be there, but you have to pay attention to what the narrative is on how the market's going to deliver. So it trades back down into the first presented fair value gap, which is also going to be about the upper quadrant of this 15-minute BC that we looked at right here, that we failed to get any lower than consequent encroachment on the 1-minute chart in the opening. But now we have this range that we're working with. So whatever you guys like to use for entering your trades or whatever, I'm just going to give you a few things. So we traded down below equilibrium of this 30-minute range, which is enough, which that's all it needs to do to be able to get back into a discount in order to go back up to a premium. You can also use the fact that we failed to, I'll put these back on here just so I can use it as a talking point. So if we put our octants back on here, let's actually even just use the quadrants to not get too technical. So we basically got to the lower or the upper quadrant with the bodies of the of this 15-minute buy side imbalance, sell side efficiency, but again failed to get to the consequent encroachment of it and failed to get below these lows. And then we begin to rally. So here's another thing is if you are a Fibonacci trader, if you take your optimal trade entry, you can either use this high, but a lot of times, even if you just use this range from the 30-minute range, there's your 62% right there, your 70.5 to 62%. There's your retracement. So our bias was up here. after trading into a higher time inefficiency. Our bias was up here. Once it got above and made the range, it consolidated. So the narrative was it may still be our draw, but the narrative is it's going to consolidate and dip into a discount one more time and then rally up towards our higher time frame bias and our draw. Now, let's take a few things off here, and I want to show you one other thing. Let's go ahead and take, well, let's leave, yeah, let's take this one off here because that was this 1 minute sell side imbalance, buy side inefficiency right here. But so we still have the, our draw is the consequent encroachment of the opening range gap, which, let's go back over here, is this opening price here to this, that should be right there, that close right there. And again, it's going to be off a little bit more because I'm using the 15-minute chart. But nonetheless, that's the gap. So our draw is this consequent encroachment right here of that. So let's go back to the 1 minute chart and I'll show you something else here. So from a narrative perspective, again, rather than trying to give you a bunch of different ways to enter a trade, I'm giving you kind of market profile and narrative. So this could have ran up here and traded down into here and just been gone. Then the narrative would have been it's going to drop down into a small discount, make the range, drop down into the range just a little bit, and then it's gone to our higher time frame draw. That's not the narrative today. So if you understand and have studied a little bit of the market efficiency paradigm, what we do is we trade up here and we stop. I'm going to take off this 10 o'clock right here because here's the 10 o'clock open. So we trade up and take out this initial AM buy side, create another, let's see here, this is the 959 right there. Yeah, so at 10 o'clock, we leave this high right here and create relative equal highs right there, and then we start to consolidate. We consolidate and take it out. Take some of this off here and clean it up. So we basically have, even though we took out buy side, we have consolidation from the body's perspective. So on a shorter term perspective, we consolidated in all of this right here. This is a lot of consolidation. And we could even go down to looking at it from this perspective. You could go down to these bodies there, and we can call this consolidation on a 1 minute chart. We can call this consolidation. The low of this consolidation was taken out. The high of this consolidation was taken out right here, right there. And then we came down here and took out, and we have this one drop down here, which left this. So what we have is the remaining part of this consolidation right here, even though this high was taken out and this low was taken out. Now what's left is more consolidation right here. So the low, let's do that. So the low of all of this consolidation was completely land-based and taken out down into a discount. The high of this consolidation was left intact, which can be a clue to right now, narrative-wise, our draw is bearish down into some sort of a discount, whether it's just briefly below the equilibrium of this range or deeper. But keep in mind that if we have a higher time frame bias, that from a narrative perspective, yes, this is a valid trade here, but keep in mind that our draw is bearish. But from a perspective of, is it actually going to go and take the low of this range? This consolidation and the high of this consolidation can be an indicator that it's only going down into a discount to go back up because it left this consolidation right here, especially knowing that we have a higher time frame draw, which is the upper quadrant of this gap. So anyway, that's how I would read this for the morning session. But let's go back to the main thing that I want to point out is that I went into some of the how to read the bias as well as the narrative. Obviously, the daily bias was the morning session bias was bullish. Let me put it that way, because of the opening range gap, 50% level, as well as again going off of a higher time frame inefficiency when the market opens. What's the inefficiencies below price, and where's the liquidity? So obviously when it trades down and gets stopped by this inefficiency and then starts to rally, that's your first clue that we're going towards buy side and buy side inefficiencies potentially first before we go down here looking for this. That's your first clue. And that's the bigger thing that I want you to see. And what I've noticed in my back testing is that if you wipe everything off the chart, let's just take everything off the chart, is that if the minute this market opens at 9:30 and the first thing that you do is don't get FOMO, don't get worried about missing out anything, and you just go, okay, where is my 15-minute swing high below price and any others that might be salient, and where is my 15-minute inefficiencies below price? And then do the same thing. Where are my 15-minute swing highs above price, and where are my inefficiencies above price? So inefficiencies above price are there. And we'll just mark out the closest one is there. And then we have this one here. And then aside from the obvious, we have our opening range gap right there. So if all you do is take that and drop to the 1-minute chart, even if you're on electronic trading hours, yes, there's pre-market, but even if that's all you do and go, we open at 9:30, off 1 minute. 9:30 right there. So if all you do is mark that out in the first few minutes and know that everything on your chart from a liquidity perspective, I'll make those in blue and we'll make them bigger. And then let's see, right here, blue and bigger. So if all you do is look at your chart from this perspective, and then you can look at your draw, you can know where your draw is. It may not necessarily go all the way to your draw, but with those regular trading hours, higher time frame off the bellwether chart, when this opens at 9:30 and the first 15-minute candle closes and then the second candle closes and trades up and makes a change in the state of delivery bullishly, knowing that you have a 15-minute regular trading hour PD array that stopped it, that's all you need to know. If you know market structure and a few entry patterns, all you need to know is that if it's not going to go lower to here, clearly that's not letting it, it's not showing anything that it wants to go lower to here. So whatever entry pattern that you like, that flips your draw to 50% of this. If you just go off of regular trading hours and the bellwether chart, that flips your draw in those first two candles. It's very clear your draw is now bullish. So how far it goes, whether it gets to 50% or gets to that, is irrelevant. Because if you still want to look at regular trading hours, you can, because you have pre-market buy side in here and you have pre-market buy side in here. So having those higher time frame, that's going to help you with your draw. Now the narrative of how it actually gets there that's another story, but that's where having those PD arrays on there will help you. Even if you go to regular trading hours on the 1 minute chart and look at it this way and go, having nothing to do with anything prior to 9:30, having nothing to do with that, if this market opens at 9:30 and trades right here, and immediately when it opens at 9:30, it reveres back to regular trading hours, and you have PD arrays on here and liquidity that is based off the 15-minute chart, you don't even need, if you understand entry patterns, you don't need pre-market anything. It's beneficial, but it's easy to get overwhelmed and complicated. The market opens and trades down into a 15-minute BC, fails to get to, on the 15-minute chart, fails for any bodies to close or get close to the consequent encroachment of it. Then you have a change in the state of delivery and a first presented fair value gap. So right away, if we go there, first presented fair value gap, AM, and then we jump back to this chart right here, immediately we know the bodies of our two candles, this second 15-minute candle has not even closed yet. It's just rarely opened. Right away, you can say the bodies of those candles, which is the bodies tell the story. We can't even get to the middle of this BC. So if we can't even get to the middle of this BC, we're not even getting down here right now. So during the opening range, what does ICT say? 70% of the time, it's going to hit consequent encroachment of this opening range gap. So going back here, even not having anything electronic trading hours, that right there tells you your bias. If you're not even sure of a bias, and without having anything pre-market, what is our draw? The opening price at 9:30, this right here, and 50% of that. Those are your two draws right there. Now, if this had come all the way down here and the 15-minute candle closed below this, then obviously this is we looking at this as being an inversion fair value gap trying to get there, but it didn't. So even on the simplest forms, 9:30 open, trades down, first presented fair value gap, fails to get to consequent encroachment, or even on the 1 minute chart, you could say it gets to the lower quadrant of this on the 1 minute chart, but the bodies are still staying up here and can't get any lower than that. 1 minute change in the state of delivery, first presented fair value gap. 1 minute chart, you have a candle close above that 15-minute CB. There's another clue right there. Trades down into this gap right there. Entry, even if you just go to this AM buy side right there, that's a decent, if your fill's there, and you got 82 handles in 6 minutes with zero drawdown. So you get the point of what I'm getting at. So the regular trading hours off the bellwether chart, liquidity and inefficiencies can be very helpful without and keep things simple for you if that is something that is beneficial to you, then great. So anyway, again, this is kind of more for my back testing and for my son Garrett to watch. So anyway, there you have it.